Bank failures aren't uncommon, a few typically happen each year. So it's rare for there to be years like 2021, 2018, 2006, or 2005, when there were no banks closed. But 3 major banks have failed only in this month. It's an alarm bell for upcoming global recession, which hit hardly to lower-income countries. Signature Bank, a New York financial institution with a big real estate lending business that had recently made a play to win cryptocurrency deposits, closed its doors abruptly on Sunday, after regulators said that keeping the bank open could threaten the stability of the entire financial system. On Friday, Silicon Valley Bank, a lender to some of the biggest names in the technology world, became the largest bank to fail since the 2008 financial crisis. Silicon Valley Bank provided banking services to nearly half of the country's venture capital-backed technology and life science companies, according to its website. Californian bank Silvergate announced its failure on March 8, confirming that its bet on the cryptocurrency industry had turned into a nightmare. The company announced its intent to wind down operations and voluntarily liquidate the bank in an orderly manner and in accordance with applicable regulatory processes, it said in a press release on March 8. It's all collapse that will cost many investors dearly. Here is a big question on U.S. agencies and institutions. Impact on the economies. A bank collapse can have a significant impact on the economy, particularly if the bank is large and plays a significant role in the financial system. Here are some potential impacts. 1. Loss of confidence. A bank collapse can undermine confidence in the financial system and cause investors and consumers to lose faith in the stability of the economy. This can lead to a decrease in spending, investment, and lending. 2. Credit freeze. Banks provide credit to individuals and businesses, and a bank collapse can lead to a credit freeze as other banks become reluctant to lend. This can make it difficult for businesses to obtain financing, which can lead to layoffs and a slowdown in economic activity. 3. Systemic risk. A bank collapse can also create systemic risk, where the failure of one institution can trigger a chain reaction that affects other banks and financial institutions. This can cause a domino effect and potentially lead to a broader financial crisis. 4. Government intervention. In some cases, the government may intervene to rescue a failing bank to prevent the negative economic impact. This can involve injecting capital, providing guarantees, or even taking over the bank. 5. Job losses. A bank collapse can lead to significant job losses in the banking sector and in businesses that rely on financing from the failed bank. This can lead to a decrease in consumer spending and further exacerbate the economic impact. Overall, a bank collapse can have a wide-ranging impact on the economy and can take years to recover from. It is important for banks to have robust risk management processes in place to minimize the likelihood of a collapse and for governments to have contingency plans in place to mitigate the impact if one does occur.